Hi, welcome to Deloitte Financial Reporting Updates, our webcast series for issues and developments related to the various accounting frameworks. Today's presentation is Bringing Clarity to an IFRS World, IFRS Quarterly Technical Update. I'm John Kligman, your host for today's webcast, and I'm joined by others from our national office. Before we get to our agenda and speakers, a couple of housekeeping items. As you're aware, this webcast has been pre-recorded. If you know of colleagues who couldn't listen in to the webcast at this time, they can simply access the webcast at www.deloitte.com/ca/update at a later date. Now let me introduce our speakers and discuss the agenda. First, you'll hear from Kerry Daniluk, who'll provide an IFRS Interpretations Committee update. After Kerry, Maurice Vondet will discuss new developments on IFRS 15, revenue from contracts with customers. After Maurice, Anne Lamb will provide an update on the leasing standard, as well as provide insight into future accounting amendments. I'd like to remind our viewers that our comments on this webcast represent our own personal views and don't constitute official interpretive accounting guidance from Deloitte. Before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. I'd now like to welcome our first speaker, Kerry Daniluk. Kerry joined Deloitte as a partner in 2006 with over 20 years' experience in public practice, standard setting, and industry. Kerry is currently a partner in Deloitte's National Assurance and Advisory Services and specializes in a variety of areas of IFRS, IASB, and not-for-profit accounting. Over to you, Kerry.
Thanks, John, and good day, everyone. So as John mentioned, today I'm going to discuss some aspects of the recent IFRIC meeting and some of the decisions that they've made. In March 2015, they did discuss a number of different topics and ongoing projects, some of which we'll no doubt be updating on in future webcasts as they get more advanced. So today, what we're really going to do is confine our discussion to a number of tentative agenda decisions that they have finalized, the IFRIC has finalized, related to IFRS 11, which is, of course, the joint arrangement standard that we got that became final in IFRS and effective in IFRS a couple of years ago. So during that couple of years, or really the few years since the standard was issued, there have been a number of interpretive questions raised. And the IFRIC has dealt with a bunch of these and discussed a number of them and finalized some decisions in the March 2015 meeting. So they've decided not to take any of the matters onto their agenda as projects. So this means that there won't be any standard setting activity out of these discussions or any new IFRICs or amendments to the IFRS standard itself. But they do provide their comments and their notes and their reasoning for not taking these questions onto their agenda. And sometimes those, while not authoritative, sometimes those notes and basically the final decision that they publish offers some helpful interpretive guidance in how they believe the standards should be interpreted. So while we're not changing IFRS 11 at all, it does add to these agenda decisions does add to the sort of the body of literature out there that's available for something that you might look at is if you're trying to look at different interpretive matters under IFRS 11, which you will know if you had to deal with it, did have a number of challenges around how things should be interpreted. So on the first slide here, we've got the decision tree basically which takes you through deciding whether your joint arrangement is a joint operation or a joint venture. And of course, you'll remember that that's an important determination because joint operations and joint ventures get different accounting, with joint ventures being accounted for under the equity method, and then a joint operation, each party accounts for its share of revenues, expenses, assets, and liabilities. So it is an important consideration. And really a big area for interpretive questions has been around the part of the slide that's got the circled box on it, other facts and circumstances. So as you work through, one of the first questions is whether the arrangement is conducted through a separate legal entity. And so if so, well, first of all, I guess if not, that's the easier consideration, then it's a joint operation and the operators are accounting for their share of revenues, expenses, assets, and liabilities. Sort of almost quasi kind of line by line consolidation of each of the items, what we used to call proportionate consolidation. So so that's sort of the easy case. But where the issues have arisen is as you work down this decision tree and you pass through the legal entity questions and the questions about the contractual arrangements, and you get to this notion of other facts and circumstances. And the idea is that there might be other facts and circumstances present in the arrangement that indicate that the parties to the arrangement have rights to assets and obligations for liabilities, in which case you'd end up back in the joint operation camp, even if you had a separate legal entity, for example. So, and what we saw in Canada in our implementation of IFRS 11 is it's often in that box that we end up, because a lot of the joint arrangements are conducted through a separate legal vehicle, and so you do sort of pass your way all the way down into other facts and circumstances, and we see such things as both parties are buying all the output, for example, which may be an indicator that you have a joint operation. So a lot of the tentative decisions that are, sorry, the final decisions that we will talk about today that the IFRIC has just released out of their March 2015 meeting do center around this question of interpreting other facts and circumstances. So on the next slide, issue 1, first addresses whether the assessment of other facts and circumstances should be performed considering other facts and circumstances that create enforceable rights to assets and obligations for liabilities. Or is it a matter of we could just look at the design, purpose, and maybe the entity's business needs and past practices? So maybe everything's not written down, but that's how we always do it, or that was our intention, and so on. So the IFRIC did discuss this question, and where they've landed is, or what their notes indicate, is that they believe that these rights, these facts and circumstances need to create enforceable rights to assets and obligations for liabilities in order to be, really considered in the other facts and circumstances part of the test. If they're not enforceable, then they should not affect the determination of joint operation versus joint venture. So at the end of the day, the IFRIC decided that this was clear enough within the body of the standard that already existed in IFRS 11, and so the issue has not been added to the agenda. But as I said, it does give us an important indication that they do believe that these should be enforceable rights. So, of course, that doesn't answer all the questions, because we still get questions about, does it need to be written down? Could you have an enforceable right based on a verbal agreement, and so on? And so I think those are still questions, and really what's enforceable may come down to a legal question. So it doesn't answer everything, but at least it gives us some indication that they believe that there should be enforceability. So the next question is next they talked about how and why particular facts and circumstances can create rights and obligations. And so there they sort of looked to, well, we need to think about the rights and obligations that get created outside of the existing legal agreements. So for example, once you get down into this box, you've already passed through considerations of the separate legal entity and the rights and obligations that the nature of that separate legal entity confers. And so then you're talking about, being in, as I mentioned, enforceable rights and obligations, something that overcomes or goes beyond what's already in the existing legal agreements and legal arrangements that are inherent in the nature of the legal entity that you have. So again, they've decided not to add anything to the agenda on that point. The next slide discusses the whole question around purchasing, the next number of issues talk about this whole idea of purchasing, the parties to the arrangement purchasing the output. So as we've seen in practice, that's a common consideration in figuring out whether we've got a joint operation or a joint venture, because it's often the case that the parties to the joint arrangement are purchasing all of the output. So that's given rise to a number of questions about those purchase arrangements and other factors in the arrangement, and what impact they might have. So as I mentioned, one of the facts and circumstances that can get you to a conclusion of joint operation is that the parties are buying all of the output. And the standard, IFRS 11 itself, actually has an example where the parties are buying all of the output, but they're buying it in a cost plus arrangement. So they're not paying market price for the output necessarily. They're paying, cost plus a margin. And so that gave rise to a lot of questions. Well, what about if the purchase price for the output is market? And that's actually the more common thing that we do see in Canada is purchase arrangements at market price. So, it's a perfectly valid question and one that we certainly consider through the application or implementation of IFRS 11. So the agenda decision that they've published goes through really to say that it's really important to think about the cash flows and where those cash flows come from through the parties' obligations to buy the output. And so whether it's at market price or not is not necessarily determinative in the determination of whether it's a joint operation or a joint venture. So I think that's a good interpretation in the sense that that's been somewhat consistent with how we've interpreted the standard, or pretty much consistent with how we've interpreted the standard as we implemented IFRS 11 in Canada. The next question is still, within the context of the parties buying all the output, what if you layer on the idea that there's third-party financing as well? So in that case, the question arises perhaps because you've got not only the joint arrangement parties providing the funding and the cash flows for the joint operation, but also there's a third party involved who's provided funding. And again, the IFRIC has noted that they don't believe that the existence of third-party funding should affect the classification. So, based on the other factors that are present, it may be sort of neither here nor there. They do note that yes, some of the obligations, some of the cash obligations in the joint operation may be settled by the third-party financing, but eventually that third-party financing needs to be repaid, and it will come from the cash flows provided by the joint arrangement parties if they're in fact required to buy the output. So again, nothing added to the agenda there. In the next series of considerations, it's still within the context of buying the output, the parties buying the output. The other question was, does the nature of the output matter? So if the output is bespoke or customized, let's say, does that make a difference compared to if it's fungible or kind of interchangeable, identical type of output? So, gold bullion compared to some kind of customized manufactured output. Does that matter? And again, the IFRIC has said, well, that's not a determinative factor either. We're just looking at the cash flows in the joint arrangement and where they come from. And the nature of the product doesn't really matter. And then another question that's come up is around the volumes, or this concept of the joint arrangement parties buying substantially all of the output. So that's the words in the standard. It talks about when they buy substantially all. So of course, the question has come up, how should substantially all be interpreted? Is that volume or monetary value? So that might be important, for example, if the joint arrangement has different output and maybe, one set of output is expensive but maybe lower volume, and then the other may be a higher volume but lower cost. Should we be looking at substantially all in the context of the volume or the monetary value? So the IFRIC has said that since it's cash flows that matter and cash inflows and what the joint arrangement is earning from the from selling to the parties, then it's really the monetary or dollar value that's important in that context. The next issue that they looked at was whether two joint arrangements could be classified differently when they have similar features, except that one's structured through a separate legal entity and the other is not. So really, I guess people were asking questions, well, we believe that we should be having economic substance-based standards. So if you've got two arrangements that are similar in a lot of respects, except for one's operated through a joint, not a separate legal entity. So maybe parties are owning shares of assets directly and just kind of cooperating together. There's no separate legal entity, you know, and then you have a similar case where it is in a separate legal entity. And so in the one case with the no separate vehicle on the right-hand side of the slide, that would be a joint operation. And the other part of the slide where it's through a separate vehicle, that could be either based on the analysis of facts and circumstances. So the questions come up, does that make sense? And is that a good answer, given that if you accept that the arrangements, the two arrangements might be quite similar in other respects. So the IFRIC did confirm that they don't believe that that does conflict with the concept of economic substance, and they note that the existence of a separate legal entity can play a big role in rights and obligations. So, the differences in accounting probably are, relate to actual differences in people, in the two parties' rights and obligations. So they confirmed that that is a legitimate, not unexpected outcome. The next issue considers how a joint operator should recognize revenue in relation to the output that they purchase from the joint operation. So remember, it's a joint operation, so in this case we're looking to be recording, for the joint operators to be recording their share of revenues and expenses, assets and liabilities. And so the question is, well, if you're doing that, and so there's a point in time where the joint operators have bought the output, but they haven't yet sold it on to third parties, is it appropriate to record that revenue? And the IFRIC has, came out in their agenda decision to basically state that they believe that what's consistent with IFRS 11 and the rest of IFRS is that when it's a joint operator, if you're just recognizing your share of the revenue, it's not appropriate to do that until that output has been sold on to third parties. So that's another hint or good indicator of where they think the standard should be applied in that question. And then finally, the last topic I'm going to talk about relates to the maybe somewhat unusual situation, although we have seen it, where there are two joint operators and collectively they're taking all the output, but they might be taking it in a different proportion to what their ownership interest is. So it's possible to have, let's say, as we show on the slide, a 50-50 ownership interest, but one party's taking 80% of the output and the other party's taking 20%. And so how would you, the standard talks about joint operators accounting for their share of things, so how would you really mechanically do that when you kind of got a 50% ownership interest, but your percentage of the revenues and expenses is maybe 80% or 20%, so different than your ownership interest. So it does create an anomaly and some interesting, debits and credits as you work through it. And what the IFRIC concluded, which I think is an appropriate answer, is that there are probably a lot of different reasons why this situation can exist, and probably you need to understand those in order to come up with a reasonable accounting answer for this situation. And so there's no one right answer, but it should be a facts and circumstances judgment-based analysis. So basically those are the IFRS 11 tentative final decisions, or I keep calling them tentative, final decisions that we have, and in all cases the IFRIC has decided not to take them onto the agenda. So there will be no standard setting activity. And, I think the good news is, as I said earlier at the outset, is we often look to these agenda decisions that they do publish, even when they don't take an issue on, and they often have a lot of clues and indications of where the IFRIC thinks that the standard really lies. And even though they say at the beginning of the published decisions that they don't change anything in IFRS, they can sometimes add to or color our views on how the standard gets interpreted. So I think we've known for a while that they were looking at all these issues, and I think in Canada we were probably a tiny bit nervous about that because we're pretty, our implementation of the standard was a good 2 years ago now, and we had made a lot of these decisions in a vacuum without the benefit of having these agenda decisions. And so I think the good news is that what they've come out with really does not conflict with anything that, that at least that we believe the interpretations have been in Canada and in terms of the way Deloitte has interpreted a lot of these matters. So I think that's good news. So the body of literature for IFRS 11 has increased, but I don't think that it should pose any really too many interpretive issues. There may be some situations at the margin where maybe they do, but I think it's, this was overall not too disruptive of an outcome from our standpoint. So John, those are my comments on the IFRS 11 agenda decisions.
Thanks a lot, Kerry. Lots of substance there. And given the volume and significance of these clarifications, why weren't they treated as narrow scope amendments to IFRS 11 as opposed to IFRIC agenda decisions?
Yeah, so John, I mean, that's a good question. They could have, I suppose, gone through and decided to make some limited changes to the standard. And I think maybe there are places where the standard could be clearer, but I think it's overall it's probably good news that they did not do that. And I believe that when they get these questions, what they really do look for is whether the standard is clear enough to be applied the way it's written. And I guess that's in recognition of the fact that people have already been applying the standard, and it can be disruptive to start changing the standard so soon after it's been issued. They will often with these standards, they do post-implementation reviews, kind of a couple of years, maybe a little bit longer after the standard's released, and so we may see something coming out of that in a few years. But for now, happily, they've just they've sort of limited themselves to just publishing these decisions and basically rejected the idea of taking any standard-setting activity.
Okay, thanks a lot. I'd now like to welcome our next speaker, Maryse Vendette. Maryse is a partner in the Global IFRS Offering Services Group and is also co-leader of the Canadian Centre of Excellence on IFRS. In her more than 20 years with the firm, Maryse has spent the past 10 years offering accounting and consulting advice to both public and private companies. Over to you, Maryse.
Great, thanks, John. So switching gears now to another topic, IFRS 15, revenue from contracts with customers. So as I'm sure you can recall, about 1 year ago now, in May 2014, the IASB and the FASB jointly issued a new converged revenue recognition standard that replaces existing revenue standards and interpretations. So the IASB standard IFRS 15, as originally issued, had a mandatory effective date of Jan 1, 2017, with early application permitted. As background, in the last year since the standard has been issued, the boards formed a joint transition resource group for revenue recognition, the TRG, to support stakeholders with implementation of the standard. And the TRG has met now a couple of times, and as a result of their discussions, a number of issues have been raised to the boards for further analysis, and as well, the boards are proposing targeted amendments to IFRS 15 as well as to the US GAAP equivalent. Since then, as you're probably aware as well, the FASB has tentatively decided to defer the mandatory effective date of their US GAAP standard by 1 year, and the FASB has since issued for public comment a proposed ASU with a comment period ending May 29, 2015. So in part because of those proposed amendments to the standard, but also because of concerns on implementation timeline from stakeholders, the delayed issuance of the standards, and a willingness to maintain converged transition dates with the FASB, the IASB tentatively also decided that it would defer the mandatory effective date to Jan 1, 2018, with early application continuing to be permitted. And they have since issued a narrow scope ED on this proposed amendment on May 19th, with a comment period ending July 3rd, 2015. And it's expected that the IASB will finalize its decision on this at their July 2015 board meeting. So as a result of these decisions throughout the next few slides, we've assumed that the mandatory effective date had in fact been deferred to January 1st, 2018 for illustration purposes. So with the tentative deferral of the mandatory effective date and the board's intent to clarify certain aspects of the standard, some may be tempted to either slow down or continue to defer their implementation efforts. So here we highlight certain aspects that you should consider and strongly encourage stakeholders not to take their foot off the gas pedal too quickly, but pursue their implementation efforts. As you may know, the standard is quite comprehensive and includes detailed additional guidance as compared to existing IFRSs and far more disclosure requirements. So it's fair to say that all entities that present revenue will be impacted to some degree by the new standard, and some much more than others. So in contemplating the deferral as well, the IASB pointed out that some stakeholders had requested the deferral because they quickly realized the time to implement the standard's requirements and manage the broader implications for the business was longer than they had initially anticipated. And obviously, as you know, revenue is a critical figure in assessing the entity's financial performance and position. So as a result, its impact to an organization can be quite broad. So we would, suggest that you consider the following questions that you can see on the slide here. So will there be implications on systems? If so, can the current systems accommodate those changes, or will changes need to be made to the systems and processes, or will new systems need to be implemented? For entities that have a significant impact in terms of accounting changes because of IFRS 15, you can well see that this could cause significant issues or challenges around systems. Does the organization currently have sufficient information to address the disclosure requirements? The information that was previously used for disclosure purposes may not be sufficient. And how accessible is this information, this historical information that may not be supported by legacy systems? Who will need to be trained and educated on the new standard? And how will the organization ensure that it's facilitating this on a timely basis? Maybe another question, as you know, and as I've mentioned, there are many issues that are being discussed by the Transition Resource Group, and the boards as well are discussing many of these issues, and many of those may affect your organization. And so you have to consider, what is the impact of that? And do you have resources and processes in place to keep up to date with those discussions? Does the organization want to early adopt the standard, and have you decided on a transition method? So as noted, these are just some of the key questions to consider when assessing the impact to your business, and we encourage you to reach out to your professional advisor if you seek additional guidance. Here on this slide, we illustrate the various transition methods that may be used, and the standard provides entities with 2 transition options in applying the standard. So again, please note that on this slide and through the remainder of the presentation, we've assumed that the mandatory effective date has in fact been deferred to January 1, 2018. So under the full retrospective method, entities would apply IFRS 15 retrospectively to each prior reporting period in accordance with, IAS 8, the standard on accounting policies, changes in accounting estimates and errors. But there are a number of practical expedients that we'll discuss later that would be available to entities. In this case, a cumulative adjustment to opening retained earnings would be required at the beginning of the earliest period presented. In our fact pattern or example, that would be January 1, 2017, assuming only 1 year of comparative figures are presented. So effectively, this means all existing contracts will be retrospectively adjusted and restated to comply with IFRS 15, subject to certain practical expedients. The next transition method, which we've called the modified retrospective method, under this method, entities will apply IFRS 15 retrospectively, but with the cumulative effect of initially applying that standard recognized at the date of initial application, and that date is the start of the reporting period in which an entity first applies the standard. So in the example we have, for an entity with a December 31st year end that adopts the standard as of the proposed mandatory effective date of Jan 1, 2018, well, the date of initial application would be January 1, 2018. Under this method, contracts that are not completed as of this date would be retrospectively adjusted, but would not be required to be restated in the comparative period, meaning the adjustment, it would simply be recorded as a cumulative catch-up adjustment as at Jan 1, 2018. However, for contracts that are completed, and that's completed as defined under prior GAAP, so under IAS 18, IAS 11, and related interpretations, prior to the date of initial application, no adjustment or restatement would be required. And there would be additional specific disclosures that would be required under this method, which we'll discuss later. So, as I've mentioned earlier, under the full retrospective method, users can elect to apply any number of practical expedients that are allowed in the standard, and there are 3. These expedients were introduced as the boards acknowledged that the cost of applying all the requirements of IFRS 15 on a fully retrospective basis may outweigh the benefits to users. So, to ease transition, the boards introduced these expedients. And again, just as a note, these are only available under the full retrospective method of transition. So the first one, for completed contracts that begin and end in the same annual reporting period, entities are not required to restate those. So completed contracts are defined actually in IFRS 15 as contracts for which an entity has transferred all the goods and services identified in accordance with their legacy GAAP. So in our case, in accordance with IAS 11, IAS 18, and related interpretations. And this alleviates the need to restate those contracts in comparative annual and interim periods. The next one, so for completed contracts that include variable consideration, and variable consideration is defined in IFRS 15 as consideration that varies, for instance, because of discounts, rebates, incentives, performance bonuses, and the like, entities may use the transaction price at the date the contract was completed rather than estimating variable consideration amounts in the comparative reporting periods. So if a contract was completed in the year of initial application, the entity can use the variable consideration amount determined at that date. For comparative reporting purposes, there's no need to use hindsight. And finally, for the third practical expedient, for all reporting periods presented before the date of initial application, so in our case, periods before January 1st, 2018, entities would not be required to disclose the amount of the transaction price allocated to the remaining performance obligations and an explanation of when the entity expects to recognize that amount as revenue. And so this was actually a new disclosure requirement, or is a new disclosure requirement of IFRS 15. So in effect, there would be no need to do that presentation for a prior year, as it will be presented in the year of initial application, or the contract will have been completed by then. So at the March 2015 meeting, the boards were presented with certain concerns about practical challenges associated with one of the requirements of IFRS 15 dealing with contract modifications and how that guidance can be applied retrospectively. So the issue had been raised previously with the TRG. More specifically, the entities that raise the concerns are those that enter into multiple or multitude of contracts or have very long duration contracts that can be frequently modified. And the staff paper notes entities in the telecommunications and cable industries that enter into a high volume of customer contracts that may be modified to either increase or decrease data in a wireless plan, add or remove lines and devices from a shared data plan, add or remove channels or other services, etc. So stakeholders believe that evaluating and adjusting for the effects of contract modifications retrospectively would be challenging, regardless of the transition method selected, and they question the usefulness of this information. I just want to note as well that the issue is not limited to these industries, but the software industry, construction, aerospace and defense industries, for example, may also be significantly impacted because they may have, a high volume of contracts with long duration contracts that may be frequently modified. So as a result of those discussions, the IASB tentatively decided to add 2 new additional practical expedients to the standard. The first one, which I call the contract modification practical expedient. So to apply this expedient, a new term called the contract modification adjustment date, the CMAD, would be introduced in the standard and defined as the beginning of the earliest period presented. So for example, if modifications occurred prior to the CMAD date, which in this case we assume would be January 1, 2017, entities would not need to separately assess the effect of each modification sequentially as they occur prior to the CMAD date. Instead, the entity would use hindsight as of the CMAD date to evaluate the impact of past modifications and perform one analysis at that point to determine the resulting transaction price at that time, the satisfied and unsatisfied performance obligations at that time, and the allocation of the transaction price to the performance obligations at that time. So this practical expedient, if it's carried forward as proposed, could be used under either the transition method, under the full retrospective or modified retrospective. There's one point of detail here that the FASB has tentatively decided to define the CMAD somewhat differently. So if you are a filer under US GAAP, you might want to take cognizance of that. The IASB also tentatively decided to permit another practical expedient on transition under the full retrospective approach, and that's what I referred to as a completed contract practical expedient. So entities could elect to apply IFRS 15 retrospectively only to those contracts that are not completed contracts as of the beginning of the earliest period presented, which in this case would be January 1, 2017. So a bit of a different date, and that would be in line with the first-time adopters' allowance to adopt the IFRS 15. So moving on now, in selecting transition methods, entities should be mindful of the impacts of each method. To be clear, there's not one right answer. I think it depends on the facts and circumstances of each entity, and each method has its merits and drawbacks depending on facts and circumstances. So from a comparability standpoint, although a full retrospective approach provides greater comparability as prior periods are restated and a cumulative adjustment is recognized at Jan 1, 2017, the use of practical expedients that I've mentioned before may also reduce the level of comparability. So that may be something to take into consideration. The modified retrospective method will not provide the same level of comparability as prior periods are not restated, and the cumulative adjustment is recognized at January 1st, 2018. However, the modified retrospective method does require additional note disclosure that explains the amount by which each financial statement line item is affected in the current period, so in the year January 1, 2018, as a result of applying IFRS 15 versus applying existing IFRS guidance. And this information is not on the face of the statements, and this may be a consideration point for certain entities. From a data management and volume perspective, under the full retrospective application method, a larger population of contracts will have to be assessed to meet the recognition, measurement, and presentation requirements of the new standard. As well, there's increased volume of disclosure requirements. So the disclosure requirements are significant, and under this method, IFRS 15 compliant disclosures will also be required for prior periods presented. Under the modified retrospective method, the volume of contracts to be assessed would not be as important because of the completed contracts would not have to be restated as long as the contracts are completed before the date of initial application. And from a systems consideration perspective, With an increased volume of contracts and information under the full retrospective method comes additional systems considerations. So, for example, this information, questions that you might need to ask are, is the information readily available, or will the information be required from legacy systems? Will information exist in a manner that is compliant with IFRS 15, or will additional manual reconciliations and processes be required? Under the modified retrospective method, information is still required for disclosure purposes to reconcile legacy GAAP to IFRS in the year of initial application, and this will likely require maintaining some dual accounting systems, records, controls, and processes. So some points there to be cognizant about. And finally, in selecting transition methods, we also would point that, among other considerations, stakeholders should consider the importance of trend information, the importance of consistency among the industry and peers, the volume of contracts, the nature or characteristics of those underlying contracts, whether there are significant foreseen changes in accounting policies. All of those things may impact the transition method that you might wish to use. So with that, John, I'll give it back to you.
Thanks a lot, Maurice. Lots there, and that's just the transition. There seems to be quite a few considerations related to completed contracts for transition purposes, and they seem to be somewhat different. Can you elaborate on that, please?
Yes, good question. There are a lot, and it might be confusing, actually. So just one thing I'd like to point out before we go back on that information. The basis for conclusions of IFRS 15 clarifies that a completed contract is one where performance is complete prior to the date of initial application under legacy GAAP, so complete under legacy GAAP. But it also includes situations where, for example, there's a change in the transaction price after the date of initial application. So the basis for conclusion indicates that even in this case, the contract would still be determined to be completed. So as long as you've done everything that you'd have to do, i.e. you've transferred all goods and services, so satisfied all the performance obligations under prior GAAP, even if there's still some transaction price that hasn't yet been recognized because of, for instance, variable consideration, this may still be considered a completed contract. I think we need to consider whether a contract is in fact completed at the appropriate reference date. And so is it the date of initial application right now under the standard, but under the IASB's tentative decisions for full retrospective application, the date of a completed contract would be the beginning of the earliest period presented. I think examples of outstanding variable consideration, examples of collectibility, whether you have a performance obligation that would have been satisfied under prior GAAP, but maybe not satisfied under IFRS 15, those types of things would have to be considered in terms of determining whether you have a completed contract. And an example I can give, you may have had a contract where you've completed everything under prior GAAP, but there was a warranty, and the warranty was accounted under prior GAAP as a cost accrual, for instance. Under IFRS 15, the warranty may be considered to be an assurance type warranty that would require deferral of revenue. Well, in that case, the contract would still be completed potentially under prior GAAP because you've transferred everything and your warranty is a cost accrual, whereas under IFRS 15, it may not have been considered a completed contract. So there's a lot of these things that have to be considered from the entity's perspective. So again, just to summarize, full retrospective approach, there's a practical expedient for contracts that begin and end in the same annual reporting period. And for the modified retrospective approach, you would not restate contracts that are completed as at the date of initial application. And there's this additional tentative practical expedient that would apply under the full retrospective method for completed contracts, but at a different date, which is the beginning of the earliest period presented. So I hope that's clearer, John.
Yep, you're just a messenger there. You didn't write the standard. Thanks a lot. Okay, with that, I'll welcome our last speaker, Anne Lam. Anne is a senior manager in the IFRS Center of Excellence in Toronto and has over 14 years of experience in public practice. Anne's main area of focus is in the determination of final technical positions on IFRS interpretation and application matters for other IFRS centers around the world and client service teams in Canada. Over to you, Anne.
Thanks, John. So now we're going to move on to the exciting leases project. So I'm sure we've all been anxiously waiting for an update as the issuance of the final standard is actually looming in the horizon. I first wanted to set the stage on where we are today with the leasing standard. So it really is hard to believe that the first discussion started with the issuance of the exposure draft almost 5 years ago, and that was back in August 2010, where the IASB and FASB first proposed a new accounting model for the accounting for leases. Then, subsequent to the release of the exposure draft, they started redeliberations in January 2011 up until 2013, where a revised exposure draft was issued in May 2013. And the revised exposure draft was issued due to all the changes from the discussions over those 3 years. Then, starting in January of last year, 2014, the board started redeliberations to consider feedback from various stakeholders, including investors, analysis preparers, and accounting firms. So where we are today is that the redeliberations were completed in the first quarter of this year, 2015, and the IASB confirmed that all due process steps were completed and no re-exposure was necessary. And now a final standard is expected to be issued towards the end of Q4 2015. In this webcast, I wanted to discuss two significant project updates issued by the IASB. The first they issued in February this year on the definition of a lease, and the second was published in March 2015 that goes into a little more detail on the practical implications of the new leasing standard. So we have embedded these links in the PowerPoint presentation, so when you click on each item, it will take you to the IASB documents if you would like to get more details. So let's start first on where the IASB has landed on the definition of a lease. I wanted to spend more time on this slide as this is one of the more complex areas of standard where significant judgment has to be applied by an entity. Now, if you look at the existing definition under the current standard, IS 17, it defines a lease as, quote, an agreement whereby the lessor conveys to the lessee in return for a payment or series of payments the right to use an asset for an agreed period of time. Under the proposed standard, the lease exists when two conditions are met. So first, the contract has to depend on the use of an identified asset. And secondly, the contract has to convey the right to control the use of the asset for a period of time. Now, if you look at this new definition, it's very different from the old definition under IS 17, which focused on the right to use an asset in return for a payment. Now, the new definition focuses on who controls the use of the asset. Is it the customer or is it the supplier? And the reason why it's important identifying who controls is that if you conclude that the customer or the lessee controls the asset, then the customer will recognize the assets and liabilities arising from the lease on its balance sheet. Now, on the other hand, if the definition is not met, then the contract is accounted for as a service contract and no amounts are brought on the balance sheet. And I'll discuss the practical implications of what this means later on. So now let's dive a little bit deeper into the two parts of the definition of a lease. So the first part, the contract depends on the use of an identified asset. So what does this really mean? If you look at the slide, there's three considerations to this criteria. The first bullet is on uniquely identified asset. So first, there has to be an identified asset in the contract. Now, this asset could be explicitly or implicitly implied. And so what we see typically in practice is that an asset is identified by being explicitly specified in a contract. So for example, if the asset is a piece of equipment, it could be explicitly specified in the contract by a serial number or a model number. Now, however, even if the asset is explicitly specified in the contract, fulfillment of that contract does not depend on the use of the identified asset if the supplier has a substantive right to substitute the asset throughout the period of use. So this is the second bullet point that I've included on there called substantive substitution rights. So what this means is, for example, let's say we take a contract between the customer and the supplier, and that contract requires the supplier to transport by railway cars a quantity of goods or services, quantity of goods for the customer in a period of time. Now, let's say the contract identifies the railway cars that the supplier will use to deliver the goods. However, the supplier has a right to substitute the railway cars with any number of its similar railway cars to deliver the customer's goods. And it also has this practicability, and it makes sense economically for the supplier to exercise this right. So in this case, because the supplier has this substantive right to substitute the asset, then there is no identified asset in the contract, so meaning the first part of the definition is not met. The third bullet on physically distinct portion means that you can have a physically distinct portion of an asset being leased. So for example, a floor of a building can be an identified asset. However, if you have a capacity portion of an asset, so for example, a capacity portion of this fiber optic cable that is less than substantially all the capacity of the cable, this cannot be an identified asset, because if you look at the fiber optic cable, it's hard to say that one component is physically distinct from the remaining capacity of the asset. Now, if based on these considerations, you conclude that the contract does depend on the use of an identified asset, you still have to determine if the second part of the lease definition is met. Does the contract convey the right to control the use of the asset? Now, a contract conveys the right to control the use of an asset if throughout the period of use, the customer has the right to do two things. So first, if the customer can direct the use of the identified asset, and secondly, if the customer can obtain substantially all of the economic benefits from the use of the identified asset. So on the first bullet, a customer has the ability to direct the use of the asset when it can direct how and for what purpose the asset is used. So for example, if the customer has a right to change the output of the asset, such as they can change the quantity or the type of goods and services produced by the asset, then this means that the customer has the ability to direct the use of the asset. A customer has a right to receive benefits from the use when they have the right to obtain substantially all of the economic benefits from the use of the asset throughout the period of use. For example, the economic benefits from the use of an asset would include output being produced by the asset, including any cash flows that are derived from the use of that asset. So as you can see, critical judgment is required to determine whether the customer controls the use of the asset, in which case the contract is a lease, or if the supplier controls the use of the asset. In this latter case, the contract is for a service. You'll also see that at the bottom of the slide, there are certain exceptions for short-term leases and small ticket leases. Now, short-term lease is defined as a lease that has a lease term of 12 months or less. And if you have these short-term leases, the leasee would be permitted not to account for the contract as a lease and select an accounting policy choice instead to recognize the lease payments on a straight line basis, similar to the existing guidance under IAS 17 for operating leases. There's also a similar exception for small ticket leases. Now, these are leases of small assets such as IT equipment and office furniture. So it sounds all pretty complicated, doesn't it? Why don't we apply these concepts to a simple example just to demonstrate some of the new definition components of the definition of a lease. So here we have a typical retail rental contract. So we have a retailer, and this is a customer in this case. They enter into a contract with a real estate company, who is the supplier in this case, to use shop number 1 in a commercial center for a 5-year period. So let's assume that the asset is explicitly identified in the contract as shop number 1. So the retailer uses the premises only for operating its store brand. It also sells its goods during the hours the commercial center is open. And the retailer is provided with actually a lot of rights related to the asset. It can decide on the mix of brands sold. It can change and make adjustments to pricing. It also has rights over determining the fixtures, the qualities of the inventory held, and also space used for the storage. From the real estate company's perspective, they have to provide cleaning, security, and advertising services as part of the contract. Now, looking at the definition of a lease, you have to ask yourself, who controls the use of this asset? In this case, is it the customer, which is a retailer, or is it the supplier, which is the real estate company? And if you look through all the facts, you would conclude that it's the customer, the retailer in this case, who controls the use of the asset. And that's because the retailer has exclusive use of the shop, and it also can decide how to use it. So it can direct the use. For example, it can decide for what purpose the shop will be used. It can also decide what mix of products will be sold and when the shop is open. And so the conclusion in this example is that the contract contains a lease for the use of shop number 1, and also there's services that are part of this contract as well. And so for the lease component, the retailer would account for the lease of the shop separately from the services that the real estate company is providing, such as the cleaning, security, and the advertising services. For the lease component, the retailer would recognize the lease assets and the liabilities, reflecting only the payments that relate to the lease component. You'll note that we have a note at the bottom of this. Because we're saying there's two components to this contract, the lease and the services, and you have to separate out the lease component, the retailer could actually choose to account for the lease and service component as a single lease contract if they wanted to, for simplicity's sake. So now that we've gone through the concepts for the definition of a lease, let's take a look at what the proposed model will look like. Now this model is called the right of use model. Now it's similar to the current finance leases under IAS 17. If you look at the balance sheet, you'll see that in essence there's a gross up on the balance sheet. You recognize a right of use asset, and there's also a corresponding lease obligation. If you look at the income statement, there's been a movement amongst various line items. So if you look at operating expenses, this would be the lease expense. This has been replaced with amortization and interest expense. The amortization because of the right of use asset that you have recorded on the balance sheet, and the interest expense because of the lease obligation. Now, at the end of the day, EBITDA will change because what was previously recorded above the EBITDA line as operating expense is now recorded below the line in amortization and interest expense. So now let's apply the right of use model to a numerical example. So in this example, we have a lessee, and they enter into a 3-year lease, and they agree to make the following annual payments at the end of each year. So let's say at the end of year 1, they have to make a $10,000 payment. Year 2 is $15,000, and year 3 is $20,000. The initial measurement of this right of use asset and the liability to make the lease payments, so let's assume this is $38,000, and a discount rate of 8% is being applied. For simplicity, let's assume that there's no initial direct cost to enter into the lease. So what do? Let's take a look at the table below in the slide. So on inception of the lease, you would recognize a right of use asset of $38,000, and there's also a corresponding lease liability of $38,000. If you look at year 1, looking at the asset would be amortized, and we're assuming a straight line basis in this case over the 3-year lease term, and this is approximately $12,000 each year. So at the end of the 3-year term, you'll see that total amortization expense is $38,000, which brings the asset to a nil balance at the end of the lease term. Now, if we look at the lease liability side, that would be accreted using the effective interest method, and interest would be recognized over the 3-year period for a total of $7,000. If you just look at the end result, at the end of the 3 years, you have a total lease expense of $45,000, which would be recognized. Now, this is the same as under the old operating lease model, where if you take the total of the lease payments over the 3 years of $10,000, $15,000, and $20,000, this would also be $45,000. But the difference you will see is that under the new proposed model, and we've highlighted this in the yellow column, the total lease expense is front-loaded such that there's a higher expense in the earlier years, whereas under the old model, you would have recognized lease expense on a straight line basis over the 3-year period. So in looking at even this simple numerical example, this is definitely a significant change. So this slide summarizes at a high level what the practical implications of the new model are and the impact on the entity's financial statements. So looking at 3 parts, if you look at the balance sheet, as I mentioned before, you have a right of use asset as a separate line on the balance sheet, or disclosed on the notes, and you would present lease liabilities as a separate line item on the balance sheet or disclosed in the notes. On the income statement, you would present separately the amortization of lease assets and interest on lease liabilities. On the statement of cash flow, you would classify the principal portion of lease payments and financing activities, and you would classify the interest portion of the lease payments in operating or financing activities. So as you can see under the new model, recognizing all leases on the balance sheet will have significant implications on an entity's financial statements. Now this slide summarizes what the impact will be on financial measures. So let's first take a look at the table on the right to see how the various line items will be impacted. To put this into context, this assumes that under the existing model, the lease is an operating lease, and under the new proposed model, all leases will be on the balance sheet. So just looking at the balance sheet, there will be a gross up of assets and liabilities reported. You'll see that the leased asset will be recognized on the balance sheet as this right of use asset. There'll also be a corresponding entry to lease liabilities, and equity is expected to decrease because the carrying amount of the lease assets will typically reduce more quickly than the carrying amount of lease liabilities. So this will result in a reduction in the reported equity compared to today for lessees with material off-balance sheet leases. On the income statement, you'll see that rental expense will decrease because it is being replaced by amortization and interest expense. The amortization is from the amortization of the lease asset over the term of the lease, and the interest expense is from the interest on the lease liabilities. Now, the overall impact is that your operating profit is expected to increase because now the interest expense is recorded below the operating profit line. And EBITDA is expected to rise because the operating lease expense is removed and the amounts are recorded below the EBITDA line in interest and amortization. With all these changes, you'll see that this will impact the financial measures, including your debt equity ratios, your current ratio, interest coverage, and also the asset turnover. Now, the impact would be is that given that an entity's bank covenants are often driven by these ratios, it is critical that the company anticipate the impact and so that it can adjust any bank covenants if needed. So now you can see that the new standard is quite complex. A lot of judgment is required. The good news is that we have a lot of available resources to help you through the guidance. We've listed these resources on the slide, and we've included the embedded links in the slides. So all the guidance can be found on IS Plus, and the link we have included at the bottom of the slide for reference. So now moving on, the Leases project is only one of the many IASB projects. This next section will discuss the status of the IASB's other projects. Look at the next remaining 6 months of this year. We have many projects that are in various stages. In completing a project, the IASB would issue a discussion paper, an exposure draft, and then the final IFRS standard. And if the issue relates to an IFRS Interpretations Committee item, then a target draft interpretation would be issued. Now, I'm not going to go through all of the projects that are expected to be issued in exposure draft format or target discussion paper, as you'll see the timeline on the slide there. But we wanted to emphasize that it's important to monitor these developments because at the drafting stage, you may submit comment letters to the IASB within the permitted comment period. And so the IASB may take these comments into consideration when drafting the final standard. So therefore, if you strongly object to certain aspects of an upcoming standard, you do have the opportunity to voice your comments to the IASB in a comment letter during the drafting stages. So finally, let's take a look at the status of all the IASB's projects on their work plan. The IASB work plan was updated on May 5th, and in the interest of time, I won't discuss every line item, but wanted to highlight some of the more interesting projects. In the upcoming exposure draft, I think I mentioned that the conceptual framework exposure draft is expected in Q2. I think this is quite an interesting project as it sets out the concepts that underlie the preparation and presentation of the financial statements. And I think it's interesting also because this project the objective is to improve the financial reporting by providing the IASB with really a complete and updated set of concepts to use when it develops or revises its standards. On the next slide, you'll see that we have quite a number of narrow scope amendments, and I'll just highlight a few interesting ones. The one, classification of liabilities. We discussed this in our Q1 webcast, and so the issuance of the exposure draft in February of this year is actually stirring some anxiety. The exposure draft proposed amendments to IS1 to clarify when a liability is classified as long-term, and it will be in deliberations into Q3 2015. 15. So there will be many that will be monitoring this one closely. If you'd like more details on this one, please refer to our Q1 webcast archive. And then the last one I wanted to highlight is the fair value measurement of a unit of account. The exposure draft on this one was issued in September 2014 and is also causing some concern. The amendments propose that the measurement of investments in subsidiaries, joint ventures, and associates should be at fair value when those investments are quoted in an active market. So it is currently in the redeliberation phase in Q2. So as you can see, there are a lot of moving projects ongoing, and we will definitely provide another update on our Q3 webcast. So John, turning it back to you.
Thanks, Anne. Turning back to the leasing project for a minute, you mentioned that the effective date for the new leasing standard hasn't yet been published. Is there any sense of when the new standard will be effective?
That's a good question, John. It's interesting because the boards are keeping quite silent on the effective date of the new standard. But given that the effective date of IFRS 9 and IFRS 15 is January 1st, 2018, it would seem very unlikely that the effective date of the new leasing standard would be any time before 2019.
So with the effective date being that far away, what should entities be doing now, if anything at all?
That's a really good question as well. So although the date does seem far, far away, and we realize that everyone has their deadlines that are due now, there are some things that you can do just this year or in the next year to prepare for the changes. I would say the most important thing is to really inventory your existing lease agreements and to identify the data that is required to comply with the new requirements. So if you look at your systems perspective, you should take a look to see if your systems need to be enhanced or should they be upgraded to capture any of the relevant data. And knowing that new system implementations may not always go according to plan and may take several years to implement, what we suggest is wise to kind of look at this earlier than postpone it to much later.
Okay, thank you. Thanks again to our speakers today, Carrie Daniluk, Maurice Vondet, and Anne Lam. I'd also like to thank our behind-the-scenes team, Nura Tayev, Karen Kular, Elise Beckles, and Alan Kirkpatrick. We hope you found this webcast helpful and informative. If you have any questions or feedback, please contact your Deloitte partner or other Deloitte contact. And if you'd like additional information, please visit us at our website at www.deloitte.ca. And to all of you viewing our webcast today, thank you for joining us. This concludes our webcast, bringing clarity to an IFRS world, IFRS Quarterly Technical Update.